So what are these called? These are called profitability ratios. Now what are profitability ratios? It's very important. Ratios are important for us either to calculate our sales, our gross profit. If in the exam they give you the cost of goods sold and they want you to figure out sales, but in the actual world, why is it very important to calculate ratios? Because we can do comparison, right? We want to compare, okay, company A, how did it do last year and how is it doing this year? Are we having better profitability? For these we need ratios. I'll explain detailedly after this. Now I've introduced three ratios. What are they? Gross profit margin, markup, and net profit margin. So GPM is gross profit over sales, markup is gross profit over cost of goods sold, and net profit margin is net profit over sales. So basically, if you get gross profit margin like what I have done here, you know that gross profit is 20%. Since the denominator is sales, sales would be 100%. Right? Now, how do we interpret this? We interpret this that for every $1 the company makes of sales, the gross profit for the company is 20 cents. Whereas markup on the other end, we can't use that. This markup is normally used in the factory setting. They want to calculate the selling price of the company, we will use this. Now, what does net profit margin tells us? Now, we got our GP here, right? Sales minus cost of goods sold, you have your GP. Now, you minus your expenses, you get your net profit. Got it? So, how do we figure out net profit margin? Net profit over sales times 100. So what does this tells us? This tells us for every $1 of sale, the net profit is XX cents, whatever cents they've given you or percentage you've calculated. Got it? Now, in profitability ratios, you need to know four ratios. So three have been introduced. The next one is called the return on capital employed. Return on capital employed. Now, in the short form, we call it ROCE. You would see this in exam often. ROCE. Now, what's the formula for this? Formula for this is net profit over capital. Now, because this is capital employed, right? Plus non-current liabilities times 100. Got it? So here we want to know what is the profit per dollar invested in the business. Got it? This is more like the shareholders want to know what is the profit the company makes for the per dollar invested in the business. Profit or net profit per dollar invested in business. Now, example. Let's say the net profit is 20,000. Now, capital employed is 80,000. That means capital is 80,000. Now, you have a long term loan of 20,000. So, what you have here, 20,000 over 100,000, meaning it's 20% times 100, right? Times 100. So that gives us 20%. Okay. So, what does this tell? This tells us for every $1 invested in the business, the net profit, the business worked hard to produce net profit of 20 cents. Okay.